Has the altcoin bull run ended? Has liquidity become trapped at the top? And why did the dream of 100 times profit fade away? This content is not financial advice. Always do your own research and never invest money you can't afford to lose. Today, let's speak clearly. Expectations in altcoins were sky high, but the market didn't respond with the same energy. Let's break down why in simple, real-world terms. Let's start with the main reason. Money didn't spread. Big money stayed in big coins, Bitcoin, Ethereum, and a few others. That's where the liquidity is. It's easy to enter, easy to exit. But in smaller coins, there are fewer buyers and sellers. A single order can move the price a lot. That might look exciting, but it's not stable. And when volatility hits, that imbalance becomes a problem. The exits are small, orders are thin, so the smallest panic can look like a crash. This is why institutional money doesn't flow evenly across all projects. It stays where markets are deep and predictable. There's also another major reason. Expectations moved faster than reality. In every cycle, hype runs ahead of real progress. And this time is no different. Many projects still don't have a working product. User growth is weak. Communities are active online, but inactive on-chain. Without real usage, prices can't rise for long. It's that simple. Promises create attention, but only adoption creates value. Until real adoption happens, momentum will keep fading after every short rally. Another key factor is risk appetite. When uncertainty rises, whether from global markets, interest rates, or regulation, people reduce exposure. They sell small cap coins first, then mid caps, and finally large caps if fear keeps spreading. This isn't emotion. It's just math. Large caps have liquidity. Small caps rely on confidence. And confidence always moves slower than capital. Think of it like the ocean. When the tide goes out, the shallow pools dry first. That's what happens to small cap altcoins in every stress period. Now let's explain what people mean when they say liquidity is trapped at the top. Imagine a shopping mall. The upper floors are bright and crowded. The lower floors are empty. At the top, trading is fast. Everyone's buying and selling. Down below, there isn't even a cashier. Crypto markets work the same way. Bitcoin and Ethereum are the upper floors. That's where all the activity is. Small coins sit below, waiting for attention. So the lower levels stay quiet, and the small moves you see there are short-lived bursts, not real trends. So why did the dream of 100 times profit fade away? Because the cycle changed. We're no longer in the everything pumps phase. Investors have become more selective. Institutions demand proof. They want data, working products, audited reserves, and sustainable business models. Meanwhile, many tokens are still unlocking supply. More supply with the same demand equals lower prices. It's simple economics. That doesn't mean all coins are finished. It means they're being filtered. The real ones will survive, and the rest will fade quietly into history. So, what could bring them back to life? Real users. Rising daily transactions. Growth in active addresses. Working products that actually go live. Partnerships that are confirmed, not just promised. Even the language matters. When headlines switch from pilot to production, that's a big sign of progress. After that, money starts to trickle down. First into Ethereum, then mid-caps, and later into smaller coins. That's how every new bull phase begins. There are a few simple signals worth tracking. Is liquidity depth increasing? Are price spreads getting tighter? Are exchanges showing net inflows? Do project updates use strong words like integration, launch, or go live? Are there major token unlocks approaching? Are active wallets and on-chain transactions rising? If several of these are positive, momentum may be building. If most are negative, it's a signal to stay patient and cautious. And here's one more bonus clue. When developers quietly return to old projects, liquidity soon follows. Now let's picture the two paths ahead. In the first path, we get a selective rally. Large coins rise. Some midcaps follow. Most small coins stay flat. In this phase, inflows exist, but all the depth builds only at the top. In the second path, liquidity slowly trickles down. Profits are taken in large coins. Money moves into midcaps, then flows into small caps. When that happens, prices hold even during unlocks and production announcements become common. At that point, the data speaks louder than the hype. So, what's the bigger picture? A bull run isn't just about prices rising. A real bull run means more participants, more liquidity, and a wider flow of capital. Right now, participation is narrow. Liquidity circles mostly at the top. That's why the dream of 100x profits feels distant. But that doesn't mean the game is over. It means we're in the quiet phase, the part of the cycle where strong hands build and weak hands get bored. Then, when data, usage, and sentiment align again, the next move begins fast. Markets don't warn you. They shift slowly, then move all at once. So here's the takeaway. Not stories, data. Not words, flow. Not hope, real usage. Because in every market cycle, hope comes first, money comes second, and proof wins in the end. Focus on what's real, and you'll already be ahead when the next wave begins. And remember this, the biggest profits never come from hype. They come quietly when nobody is paying attention. When markets look boring, that's when smart money is positioning. When sentiment is cold, that's when foundations are built. The next bull run won't start with fireworks. It will start in silence, with data improving, liquidity spreading, and usage growing step by step. So don't chase the noise. Watch the flow. When everything feels too quiet, that's usually the sound of the next wave forming.